26 years of CNBC-TV18.
Hello and welcome to MF Corner. I'm Sonal Bhutra and with me as always is Vinnii Motiwala. And we ask you to send us queries and you have sent some of them. We've received them via social media, texts and a lot more mediums as well. So thank you for tuning in and writing to us. So let's get some of those queries answered as well. To answer all your queries, joining us today is Mohit Gang, who is the CEO and co-founder at Moneyfront. Mohit, good afternoon. Thank you so much for joining in. And let's just start with the first one. There are so many which have been sent to us. The first one is coming in from Kshitij Khandelwal. He's writing to us from New Delhi and wants to know which are the mutual funds for children's future. So, of course, it would be for studies, for other travel purposes and a lot more as well. Mohit, tell us which are some of the funds that he could look at, maybe solution-oriented funds, or you would consider other categories as well.
Thank you so much, Sonal and Vinnii. Thank you for having me on the show. Look, I think, Sonal, there is a solution-oriented category specifically designed and tailor-made for purposes like these, wherein you want to plan and provision for your children's higher education or their marriage or whatever. And you have quite a lot of fund houses who have specific schemes out there. So you have an HDFC Children's Gift Fund, you have an ICICI Prudential Children's Plan, you have a Tata Nippon. So all these fund houses do have a children's plan. However, bear in mind that they have a minimum lock-in of 5 years. And the withdrawal is also post 18 years or after 5 years of lock-in, whichever happens, 18 years of child's age or after 5 years, whatever happens later, right? So that's the whole thing. So my personal choice, if you would ask Sonal, is always to go in for a mix of flexi cap, small cap, mid cap kind of an allocation. Because when you're planning for your children, you have time at your hand, you can go a little aggressive. You also know that this is a pot of money which you will never touch. So it's better to plan for open-ended flexi cap, mid cap and small cap schemes. If I were to just put out a few names, perhaps you can look at a Franklin Flexi Cap, you can look at a Bandhan Flexi Cap, an Invesco Large and Mid Cap, or maybe a Bandhan Small Cap or an Edelweiss Mid Cap. These kind of funds, they give you the flexibility and they are pretty much good to go and will possibly give you higher returns also over a next 15-20 year kind of a time frame.
Okay, interesting take there, Mohit. Good afternoon. Thanks so much for joining us. Let's move on then to the next query. We have Raman Jain, who's writing to us from New Delhi. He's holding and he's asking that what should the ideal portfolio be for a retiree with an SIP of 3,500 rupees per month? He says his goal is to reach 3 lakh rupees for his daughter's wedding in the next 2 to 3 years.
Look, Vinnii, I think just speaking on his goals with a 3,000 rupee SIP per month, assuming a rate of return of 12%, the tenor is too small for having equity funds. But even if I assume the allocation is done in equity funds, the corpus which he accumulates will be around 1.5 odd lakhs. If he really wants to go up to a level of around 3 odd lakhs or a higher sum, then perhaps the SIP number will have to be increased to 7,000 rupees a month. From a retiree's perspective, who is saving for his daughter's education, the best choice with a 3-year perspective would be a balanced advantage or a hybrid fund. You could also look at a multi-asset kind of an allocation. And if you want a little more conservative allocation, as in the overall conservative shape of a portfolio, assuming you are doing a 7,000 rupee SIP, then I'll go for a Nifty 50 index fund, a large and mid-cap fund, and a balanced advantage fund. A combination of these three split across 7,000 rupees.
All right, so that's the split we can look at for the future plans, which is daughter's wedding. Thank you for explaining that to us, Mohit. Let's go across to the next one. Shweta Tiwari is writing to us from Patna. She says she wants to invest in small and mid-cap funds, and she's already invested in Nippon and Quant small-cap funds. Of course, we need more details like the fund that she wants, the amount that she wants to invest in, and whether it's for long-term or short-term. But looks like an aggressive portfolio is what she wants to build. Mohit, what's your take here?
Look, Sonal, I think it's pretty clear she has made up her mind that she wants to be only in mid and small cap funds. So and plus I don't, as you rightly said, not aware of the contours of our overall portfolio, asset allocations, so on and so forth. So I'll just go along and play the ball. If it's an aggressive portfolio, then there are good choices available across Edelweiss and Invesco. I like both the mid cap funds. Pretty good track record, great rolling returns, great risk matrices, and consistent. On the small cap side, Bandhan Small Cap of late has been fantastic. The portfolio is brilliant. Franklin Smaller Companies Fund, the erstwhile, and it's now called Franklin India Small Cap Fund. I think good choices. You already have Quant and Nippon, which are fantastic funds to have. So hold on to both. And if you like more, these are few names which you can add on.
Okay, some of the names that they can look at to add in if the wish is to make that aggressive portfolio. Let's keep an eye on those names there. Let's move on to the next query then, and this is coming from N. Ramesh. He's writing to us from Hyderabad. Now, this is interesting. He's saying that he wants to invest maybe through SIPs, and this is an amount of rupees 5,000 each in Motilal Oswal large cap and mid cap funds as well. He's also talking about HDFC Flexi Cap Fund as well as an SBI Contra Fund, Nippon India Growth Fund, ICICI Mutual Multi-Asset Fund. This is to build a corpus for his 9-year-old grandson. So similar to building a portfolio for your children, but what is your view here?
Right, Vinnii. So look, just going by the allocations here, 5,000 rupee per month SIP for next 10 years would fetch him around 11.2 lakh rupees, assuming a 12% rate of return for the portfolio. Now coming to the choices of the fund, I think, look, the fund which he has selected are pretty well diversified. You have a large and mid cap category and a flexi cap. Both gives him a good flavor of large cap along with some mid cap in the portfolio, though not too much of mid cap and small cap comes along by virtue of these two funds. But he has a pure mid cap fund, which is the Nippon mid cap fund, and then a contra fund and a multi asset fund. I would have rather preferred a proper cutout allocation, which has a clean large cap fund, a clean multi or a flexi cap fund, and a mid and a small cap fund, because look, it's planning and provisioning for a child, and we have the flexibility of time on our hands. So I think 9 years or 10 years is what he's looking at. So perhaps he can go a little more aggressive by having a direct small cap fund and a good mid-cap allocation in the portfolio. So out there, the choices again are similar, which I have repeated in previous questions, which is an Invesco mid-cap or a Bandhan small cap, but he can have pure play small and mid-cap allocation rather than going through a flexi or a large and mid kind of a combination. It's better to have clear-cut demarcation between the market caps and have clear choices on the categories.
Oh yes, so different market caps, they'll have different returns in every year, and of course over a longer term, if you have an asset allocation in mind, that's how you can choose where to invest for a certain goal. Let's go across to the next one. Mohit Sai Prakash is writing to us from Hyderabad. He asks how can he transfer his mutual fund assets to his children. This is a query we don't get very often. It's usually where you can invest. So this is different from the others. What's your take here, Mohit?
Brilliant question, Sonal, honestly, and I think SEBI has done fantastic, commendable work in this direction. Honestly, till some time back, if units were to be transferred from my name to any of my parents or my spouse or my children, then the only way was I need to have my units in a demat format. And from there, I used to do an off-market transfer to transfer the units or do a gift or a transmission. That was easier because you just fill a DIS slip, present it at the counter of your DP, and the units are transferred in another name, right? And it wasn't available under folio-based schemes, which were non-dematted schemes. But of late, SEBI has amended the clauses. Now it's absolutely possible to transfer units in the name of your children, in the name of your grandson. In fact, it's also possible now to gift mutual fund units, and the transmission has become extremely easy. There's some paperwork and documentation. It's not very tedious, but can be easily done. So transmission cases, addition of holders in cases where minors are turning major, or similar kind of cases where you just want to gift mutual fund units is very much possible now. And there is a process which has been laid down by RTAs. Perhaps your distributor or advisor can help you, but it's not a very tedious process.
Okay. Surely we'll keep an eye out on that view there. But let's move on to the next query then. We have Srinivas, who's writing to us from Chennai. He has made investments in Canara HSBC Life Unit linked whole life plan, the ULIP plan over there, with an annual premium of 50,000 rupees. His current fund value stands at around 19 lakh rupees. He's asking, as he's approaching his retirement in the next 10 years, will it be prudent to continue with this ULIP or gradually start transitioning this corpus into a well-established mutual fund? An interesting one there, right? Normally when you've made investments, you don't know when to actually start moving and transitioning out to maybe mutual funds or other systems, as processes as well. Mohit, what's your view there?
Look, Vinnii, first a small disclaimer out there. Number one, I'm not aware of how critical the life insurance component is for the gentleman out here in question, because along with the ULIP plan, he has also got a life cover. So what is the criticality? Does he have any other life cover, a plain vanilla cover or not? So I'm not aware of those details. But just standalone commenting on the merit of the policy. Started in 2009, contributing 50,000 rupees every year, almost 17 years of contribution. Basically, if you compute the CAGR return, it comes out to around 8.54%, Vinnii. Right? For a 17-year corpus, 50,000 rupee every year is built at around 19 lakh rupees. I need not lay the importance that if this corpus was invested into a mutual fund, even the average performing mutual funds would have delivered much higher returns in a 17-year tenor out here. I think the case is very simple. It's never ever prudent to mix investments with insurance, especially through a ULIP kind of a plan. The front loading charges on premiums paid, upfront commissions on the first 3 years of premiums paid are extremely high, and the corpus invested is pretty minuscule in the first 3 years, and the growth is absolutely negligible in first 5 years of the policy term. So my sense is, look, there is no merit in continuing the policy unless the cover is significant and it's of utmost importance out here. But if the cover is not of importance, then I would rather suggest that you take a plain vanilla life cover, which is of a good quantum, and segregate your investments through mutual funds and allocate this 19 lakhs, rehash it completely, allocate it through STPs of 6 to 9 months into mutual funds. My sense is for next 10-15 years, that would deliver you much higher and better returns and much more peace of mind with a better cover also. Individually speaking, your life cover will also get better if you take it separately.
Take that point, because there's always this debate whether insurance is investment or not. But as you pointed out, one should not mix the two. Investments are different and insurance is very different for your purposes in terms of investment and life protection as well. Let's take a quick break. On the other side, we'll continue with our MF queries with Mohit Gang. Stay tuned for that.
"26 years of CNBC-TV18.
Welcome back. You're still tuned into MF Corner, and today on the show we are answering all your individual mutual fund queries. To answer them, we still have with us Mohit Gang, who's the CEO and co-founder at Moneyfront. Mohit, Kalyan is writing to us from Mumbai. He says he'll be getting a corpus of around 40 lakh rupees through the sale of his flat. He asks which of the mutual funds can give him monthly return of around 30,000 rupees if he invests through the SWP route. Very specific amount to be invested via the SWP route. What are some of the options he has, Mohit?
So look, 40 lakh rupees of corpus, if I were to assume a 9% return, which is not difficult to do in the markets, which will mean 3,60,000 rupees of annual earnings perhaps, and which would also mean 30,000 rupees a month, which is what Kalyan is looking at. So it's doable. It's doable through a very balanced corpus. You need not be extremely aggressive to do that kind of work. There are other ways of achieving that, which is he can invest this entire amount in good fixed income securities, direct bonds perhaps, which would give him anywhere between 8 to 10%. A good basket of AAA, AA kind of papers would yield him that. But because he's asked a mutual fund route, the other way of looking at it is divide the entire corpus into two buckets. I would make a bucket which is a smaller bucket of 10 lakhs, which is completely planted into liquid and arbitrage or maybe an equity savings kind of a theme, from where he can start his immediate withdrawals. Look, I'm also assuming that he requires immediate 30,000 rupee every month. right? So for that purpose, perhaps a liquid or an arbitrage fund, a 10 lakh parking, which will serve him for good 2 years kind of for his requirements. And then the balance 30 lakhs, he can park into a combination of equity funds where he can decide a balance advantage fund, perhaps a large and mid cap fund and a proper large cap fund or a flexi cap fund. He can go with a Nifty 50 index fund, a good quality flexi cap fund and a balance advantage or a multi-asset fund. This 30 lakhs, then he can start touching after his arbitrage corpus is kind of exhausted. After 2.5 years or 3 year kind of a period, he can start gradual withdrawals from here. By then, this corpus would have also significantly started increasing. He would have passed on a reasonable amount of time in the markets and the corpus would have stabilized. And from there on, I think he can start doing SWPs every month. He should first touch the balance advantage corpus and then gradually move on to his equity funds. And that's one way of laddering out his proceeds and planning for that SWP of 30,000 per month.
Okay, thanks for the view there and help there for the viewer as well, Mohit. But next query for today is coming in from Brahma, who's writing to us from Pune. He says that he has been an active equity investor for the past 6 years. He says that he's now considering a strategic shift to mutual funds to achieve his long-term financial goals. He is asking which mutual funds can he invest in for a corpus of 10 crore rupees, 200 crore rupees within the next 10-year time period. Mohit.
Vinnii, I'm at loss of words as to how to take this one. I think even Lord Brahma wouldn't be able to kind of answer this for Brahma out here. But if wishes were horses, I think this was possible. But my straight blunt take on this one is perhaps I think the expectations are a bit too unrealistic in this case. I'll just try and put some numbers in front of Mr. Brahma to kind of try and see if I can answer that. 10 to 100 is a 10x journey, which is almost a 26% CAGR for 10 years straight, which I've not known of many investors globally who could have achieved that, barring maybe a handful of names which we all quote here and there every now. But other than that, I don't know of any investors who have done that. The second point is if you see last 10 years of Nifty 50, the CAGR return is 13.7, which is 3.6 times. If you see Nifty Midcap 150, the CAGR return is 18.5%, which is 5.4 times. And if you see small cap index also, that's 15.8% CAGR and 4.3x return. So past history doesn't suggest these kind of returns, and to to kind of forecast that for next 10 years would be even tougher because the markets are maturing and perhaps your economy is resetting to a lower base of inflation, lower base of interest rates, so on and so forth. So my sense is this is unrealistic. At best, what you can do is you can prepare an aggressive combination of mid-cap, small-cap funds, perhaps few factor-based, momentum-driven funds, and hope for the best. I don't have a realistic answer or a solution to this one.
I don't think there would be a realistic solution available for this from any expert, including you, Mohit, of course, because that, as you said, 10x returns over a 10-year period, that is not something that is plausible or is not something that can happen so easily the way these returns are expected. But yes, clarifying that also is an important part of the entire show, right? You can't just get unexpected and high returns in a short period of time if you don't look at long-term investment in your portfolio. But Mohit, always a pleasure speaking with you. Thank you so much for joining in today and patiently asking those queries. We have more, but we are completely out of time today. So thank you for tuning in. And with that, we'll take your leave on this edition of MF Corner today, but stay tuned for Closing Bell to take you through the last hour of trade.
"26 years of CNBC